Hello, everyone. We're so glad to have you here. Today is a Friday, and of course, it's time for our Friday Forum. My name is Cyndy McDonald, and I'm glad to be able to welcome you to this week's Friday Forum. My guest today is Dan, but Dan, I don't even know how to say your last name. Say your last name. Bisig.
Bisig.
All right, Dan Bisig. And he's from Kentucky, right?
I am. Mm-hmm.
And of course, we have Carmen with us today. She's going to manage all your comments and chats. My name is Cyndy McDonald. I am the hostess and originator of these Friday Forums. And I'm just so honored to be able to have you join me today, and honored to have all these wonderful guests like Dan and many others that have been here over the last couple of years. As you're coming in, and I started a couple minutes early, please go ahead and put your name and where you're from. So Dan can see where you're from, and Carmen can see where you're from too. And make sure the chat is on everyone so that everyone can see where you're at. So glad to see you, Allison, all these early people. I know this is such a busy time of year. We're all just in the throes of college essays and applications and all these things. So I'm very honored that you take time out to join us today. So, and Monica, oh my gosh, you're here almost every time. And I know it's like an 8-hour time difference. So thank you for being here. I'm glad to have Andrea here as well. So we're very honored to have everyone, especially in this first week of October. So, Dan, as we get started and as people are logging in, can you tell us a little bit about yourself? Tell us about your background and what it is that you do.
Yeah. So first, thank you, Cyndy, for having me with you today. This is going to be fun. So my background's a little bit unique. I actually came about finding the college world a little differently. I was a financial planner for 25 years, and I had one of those circumstances happen where I had a family come to me, one of my clients, and they had a daughter at a Catholic school, and actually 2 daughters at Catholic schools and a son at a Catholic high school. And they said to me, Dan, what are we going to do? We only have $5,000 saved for college. And I said, Greg, where the heck were you 10 years ago when we started working together? And that got my wheels spinning. And I started to realize, I bet you there's a lot of other families just like this out there that need some guidance. And so I started doing some research, and I was able to work with the family to integrate some different things to help them pay for college, which included, they had to stop contributions to a retirement plan for a short time. They had to get some loans. The students had to get jobs and also find some scholarships. But in the end, it worked for all 3 of them. But in that process, my company, College and Beyond, was born. And initially, I was focused on the money side. And then I had another independent counselor, ironically, who happened to be in my area, who somehow found me. And she said, well, how about if I handle the admissions side? I said, this will be great. We can work together. Well, that wasn't until 4 months into our engagement and 20 families who had already signed up with us. She came to me, she said, Dan, my husband's not real happy with me. I can't do this anymore. And I said, what do you mean you can't do this anymore? And so I suddenly found myself in a position where I had to make a choice. And I loved the college process enough. I decided to go ahead and jump in with both feet and learn about the admissions process. And I was already pretty good with essays. I mean, I love reading and writing in general anyway. And so here we are 16 years later, and I still have my independent practice going. And then as you know, I've within the last few months here started to do some work also with College Aid Pro as a consultant. So filling up all of my time, all of my available time. It's been awesome.
You're not bored. I
am not bored. No, I sure am not.
So what was it like transitioning from being a financial planner to a college planner?
Oh, it was tough, without a doubt, because 16 years ago, very few people were doing independent counseling in Kentucky in particular, where I'm located. I'm only about 15 minutes south of Cincinnati, but it was it was known on the West Coast and the East Coast and like in Texas and things like that, maybe even in Florida, but not much here in the Midwest. And so it was just starting to come into the norm. So I had to do a lot of research. I got lucky in the fact I got connected with the Kentucky ACAC in the state. And, that got me introduced to great people, got connected with the NCAG. And so all of those areas, all those things helped me to get educated about the whole process. And then truly visiting colleges was transformative. And then meeting great people like yourself and others out there to help guide me as I was, getting my feet wet on it.
And I think that's important. For a lot of families, the financial part now, it used to be, well, families didn't have to worry about financial aid, or, they always felt like they had enough money to cover it. But now the cost of college have gone up so high. In order to do, I think it's both sides. And that's what NCAG is about too. It's like, in order to get into college and have something to manage, you have to get in. And so the admissions is just as important as the financial resources and what we call college affordability. So the term of college affordability has actually grown in use over the last few years. What do you define college affordability as?
Well, let me tell you how I give examples to families. I say, first, there are really three types of colleges you can attend. The first is a college that you can attend with no debt. A college you can attend with reasonable debt. Reasonable debt would be that you don't take out any more than 1 times your first year of income in debt, and then excessive debt. And I think we can all agree the problem is excessive debt is in the news media. I mean, it's what everybody's talking about. And it's because truly the cost of living hasn't increased at the same price, or the same pace, I should say, as the price tag associated with colleges. I mean, it's just brutal. It's absolutely brutal what's going on out there. And it's a big deal when even higher income families are worried about the price tag. I mean, they're even trying to judge what the return on investment is. And you're seeing the articles about return on investment and everything. So I think affordability is here to stay. I think there are a lot of families that are trying to justify the money that they're spending. But what I think they're also coming to understand is there are a lot of great schools out there where a student could get educated. They don't have to just go to the most prestigious schools to be successful in life,
And that's the message we're all trying as advisors, whether we're in a high school, in a community-based organization, or as independents. That's the message we're trying to get out there, is that there is a college that fits for everyone. Prestige is not the most important part of that. It can be a factor, but it's not the determining factor, and a prestigious school is not going to be a good fit, nor is it going to give families, some who need money to go to. So,
yeah,
so
right.
Are there any? Go ahead.
No, I was just going to say, that's why I say all the time, I believe that a student makes a school, the school doesn't make the student. And, some people might come back and say, oh, but Dan, this particular program at this particular school is #1 in the country or whatever. And I get that. Yes, there are networking opportunities and, affiliations. I mean, quite frankly, if a student wants to go on to work on Wall Street, you have to go to a more prestigious school in many cases to even get an interview. So I understand that. But for the vast majority of families and vast majority of students out there, what you do in college is a lot more important than where you go. So,
Yep. We're definitely preaching to the choir here. Yeah. Are there any other shifts or things that you've noticed over the last 10 years, or even, since you started this?
I think, quite frankly, well, #1, again, it's in the media. Everybody's talking about it. But #2, I think more families are asking the questions. I mean, they just are. They're asking about the price tags associated with schools. They're really trying to put more attention to it. The concern is that unfortunately they wait until it's almost too late to do anything. They start thinking about it as we're coming into the senior year, and it's like, oh my gosh, where were you 3, 4, 5 years ago? Like I was saying with my original client, that it truly is a process. And to the person, and I bet you can agree with me on this too. They say, "Oh, I wish I had known," or "I wish I had taken and focused on this earlier because of what I could have done, or the things that I wish I had understood about this much earlier in the process." And so that's part of the reason why I really decided to work with College Aid Pro, by the way, CAP, is because I like the fact that they're focused on getting the message out to everybody to talk about affordability, to really be careful how you shop for colleges. Think about it. People they shop for homes, they shop for their cars, and yet a lot of times they become sacrificial lambs when it comes to college, because what do they often do? They often say, "Hey, if you get into XYZ university, we will figure it out." And the "we will figure it out" often, unfortunately, ends up being loans.
Yeah. And the parents, and they're having to either sacrifice their retirement or some other things in order to make that happen. So there are some changes that are coming up on the Fafsa. Can you tell us about what the status is on that?
Yeah, oh boy, are there changes coming. So the first one that rocks just about everybody's world is when they hear that they're eliminating the multiple student discounting that happens. And what I mean by that is, let's say that a family's expected family contribution is $30,000, that it's going, and right now, if there's 2 children in college, it's about 15 per child. Well, under the new legislation, it says that it's going to go 30 per child, which is just devastating. I mean, you think about any low income, middle income family, even higher income families for that matter, it's going to impact the bottom line. So that's a huge deal. Also, there are some positives that are coming out of it, which is that they're going to, for example, eliminate the inclusion of things like disability benefits, workers' compensation, child support. Child support, instead of being considered the way it is right now, is going to change. I mean, so all of these kinds of things are going through. Another huge positive that's coming that I'm excited about is grandparent 529 plans. And we'll do a little illustration here in a little bit to talk about this. But the fact is, 529 plans owned by a grandparent currently only show up when a distribution takes place, and specifically if it takes place in the first 2 years. Well, in the future, 529 plans owned by grandparents, aunts, or uncles will never show up. And that's a huge plus. Now, I want to be very clear, though. What we're talking about here is with the Fafsa. We're not talking about the CSS profile, because the CSS profile is likely going to continue to ask those kinds of questions. Another negative that's coming is that they're going to start requiring every business owner, whether it's a family-owned business or not, to come up with a valuation to put on their business. And so think about that for a second, because right now it's one of the advantages within the Fafsa is that you don't have to list it if it's under 100 employees. Now the CSS profile, again, you still have to put a business valuation on that. So
wait a minute. So go back. So I did not know about this. And I know this is going to affect, I know some people are on the call, and I know it'll affect my families, because I probably work with 85% are small business owners, so the families that I work with. And a lot of them are also ag. So if they have a small business, less than 100 full-time employees, they still have to put a value down?
They are. And the new FAFSA, they're going to have to put a business valuation down. That's an ouch, isn't it?
And is that then going to be part of the assets then?
It will. Yeah. That's crazy, isn't it?
It's it's going back to where we were before. We for many years we had to put those down. And then when they made the changes to the FAFSA, it brought it so that the small farms, the small businesses weren't being penalized. And now we're just taking us back.
Taking it all back. And that's the crazy thing too. Let's not forget that they're also changing it back to what it was called before, which is the student aid index. And so they're wiping out this expected family contribution. They actually think that does a better job of defining what somebody has to pay, the student aid index. I don't get it. Now, let me give you one other positive that's coming. Currently, and Peg Kehoe with CAP, who I work with, did a lot of research into this as well, is that it also says that currently 401k 403B, in other words, contributions that you make into your retirement accounts get added back to your income, which does what? It bumps your expected family contribution.
Yeah, because it gets added back in as untaxed income.
That's right. That's right. It gets added as untaxed income. In the future, that's going to also disappear. You're no longer going to get penalized for saving in retirement vehicles. So that is a positive.
That's a positive.
Yeah, it really is, because every year I have families say, I'm going to show the federal government, I'm going to stuff as much money as I can into my retirement vehicles. And I say, doggone it, you go for it, because you need to save for retirement. But I remind them, it doesn't matter, because the government says you can fund your retirement or you can fund college, but either way, it's our money to count against you. In the future, that will go away. And so that's a huge deal.
So is the same for farms too, Dan? Are there going to be an exemption for family farms, or are they going to have to do the same thing?
I don't know the answer to that, Cyndy, as far as the family farms. There, the one thing I will tell you is that the legislation was passed in December of 2020, but it's still a moving target. In fact, one of our associates was talking to a representative from their state, and they had no clue that this stuff was coming down, because they had 2 kids going to college, and they had no idea that this elimination of the multiple student discounting was going to factor in. So who knows? Who knows how it's all going to shake out? Best thing we can do is all talk to our congressmen and get our families talking to our congressmen about, hey, you got to do something, because if you do that, this is going to be a mess.
Right. Dan, when will this be implemented?
Pardon me?
When will this be implemented?
Oh yeah, good question, Carmen. So it was originally supposed to be actually this year, for the FAFSA that we were doing this year was supposed to do it, but Congress, because of COVID and everything else like that, bumped it to October 1st of 2023, and it'll be for the 2024-2025 school year. So it's coming. I mean, if you're talking to your families right now, they need to know it's coming, because as you're helping them plan from an affordability standpoint, oh my gosh. I mean, if they suddenly go from a $15,000 per child to a $30,000 per child, it's a big, big deal.
Yeah, it'll impact them. So that brings us to the question that we really want to talk about today, the difference between the FAFSA and the profile. And you've talked a little bit about the differences. So, and I think with these changes in the FAFSA, what I see happening is the profile picking up that data that's being dropped by the FAFSA and pulling it in. So what are the differences, and why should we care?
Well, I mean, there's some significant differences. We already talked about the business inclusion on the CSS profile versus the FAFSA right now. You know, the fact that, again, if you've got over 100 employees, yes, you do have to include it, but if under that, if it's a family-owned business, you don't. In addition to that is just, you know, the whole, well, number one, it's all the extra questions that the colleges and universities ask. For example, there are colleges that will ask for home equity, and home equity absolutely has an impact on, in particular, because I work with families on both coasts. And so when I'm talking to folks that are up in New York or Boston, or folks in California, and they're telling me what their home values are, and they're looking at it going, oh my gosh, that's what they actually think we can pay just from the equity portion of our houses. Yep. I mean, it's incredible. It's actually, it's ridiculous, you know, and you can hope that maybe a college might take into consideration some kind of an indexing based on where you live because of that. But that's why you have to be so careful and understand the way that home equity can play a part. But again, that's what we're talking about there, is that's included in the institutional colleges that use the CSS profile. So, I mean, that's important. Again, the CSS profile is just, quite frankly, more intrusive. It's going to ask you a lot more questions about your income and your assets. Here's why. They know that families who often have their students apply to colleges of that caliber also hire sophisticated advisors to work with them. Mm-hmm. And those sophisticated advisors do some really unique things to help them reduce their income. And so, you know, that's one of the things that's just really, really important, is, you know, how both handle it. So By the way, one other positive I should have mentioned with the FAFSA in the future is that it is going to reduce the questions from a little over 100 down to about 35 or 36. So that's great. I mean, that's an awesome change. But the CSS profile is in this current state not going to change. If anything, it's actually gotten a little bit goofier because I don't know if you've looked at it yet, but there used to be a nice little running list on the side as you were working on things. Well, that's now gone. And so when you go into it, yeah, it's gone. So now you go into it and you're literally in each section and you hit continue and you go to the next section. And so they've really complicated it. I don't know if it was intentional, but it's really making it that much more difficult to review it. Compared to what you could do before, because you could click on the individual sections and just move around as you need to. So I don't know what they were thinking.
Well, that was not a good technology plan.
Yeah. Hey, Carmen.
With the implementation, will it be on families mid-college experience or just the freshmen or both with the implementation of the new FAFSA?
Yeah, that's the problem is when it gets implemented, it's going to impact families based on the current rules and regulations at that time.
Yeah.
So think about that for a minute. If you've got a student that's at a FAFSA only school, we'll just use that as the example. Because it's got to be used by the public schools and or schools that are doing that, it will impact that family. That's why it's going to rock everybody's world. I'm just telling you, it's really going to be an interesting development, which is why we've got to get out there and shout from the mountaintops that, hey, this isn't fair. What they're getting ready to do. We've got to become advocates for our families because it's really going to be a mess.
Well, and you really point out the fact that a lot of times when legislation is passed, the legislators don't really understand the impacts at all. They think, oh, this looks good on paper. It's like the whole farm thing. It only counts as a farm if you live on the farm. Well, I live in dairy world, in dairy country. Right. Not very many dairymen live on their farm for very obvious reasons. And so it's like you're obviously not from this area. You obviously don't understand the ag industry because this is a totally artificial type of thing. I think they're thinking of the old time farms where, you lived on the farm and you had your little homestead. And it's like modern agriculture is much different. And I think that's what we're finding with this law. And as you said, the legislators had no idea the impact that it would.
They don't, and so let me give you one more that I should have mentioned a minute ago. That's a big change that's also coming is with divorced families. Okay. And the reason I share this, I think that this is part of what drove them to say, we've got to do something. We know that there are situations where families have joint custody of their kids. And maybe I'm just going to use an extreme. One family member, the father and mother makes $750,000 and the other parent makes $75,000. And so in that particular case, you're always going to go with the lower income family. Okay. It makes sense. Well, that is until you start again having these congressmen talking about that and saying how unfair that is. And there's some truth in that, but what they're going to do is that they're going to change it to the parent who provides the most financial benefit to the child. And so it's going to be really interesting because I don't know how you police that. I mean, I really don't. Right now, it's the 51% rule, whoever you live with 51% of the time. But that, again, is a change that's coming as well. So a lot of these are going to be a moving target. I mean, they really are, because I don't know how you can get enough people to police what's really going on with that stuff in general.
Mm-hmm. Yeah. And that's very true. I think one of the benefits for the profile that I've seen for my families is the fact that you can put in an explanation. You don't have that on the FAFSA. It's the numbers are what they are. You can't explain, oh, I have a child that has significant medical issues and our family is putting a lot of resources into this child, whereas you can do that on the profile. Or the fact that you're paying private tuition, you can put that on the profile, and there's no place to accommodate that on the FAFSA. So that's true. that makes a difference. So it looks like we've got a couple other questions, and we may not have answers for these, but is there a percentage of the value of the small business in the calculations yet?
So I cannot tell you what that is. I will tell you that I'm sure that they're going to expect people to use some kind of evaluation. Is it 3 times of gross earnings? How do you value a service industry compared to a brick and mortar kind of a place? I mean, brick and mortar, you can come up with something based on depreciation or all kinds of stuff, all kinds of tax stuff that we don't even want to talk about today. Okay. But with the service industry, I mean, if you close down your service industry, is there really any value to it? Can you really sell it off to somebody else? I mean,
right.
So there's a lot to be said for what's going to happen with all that. So it's a moving target.
Right. Have they determined how, and this is from April, how alimony and child support play into determining who gives the most financial support? Is that part of the definition?
Yeah, April, I just don't know. I don't know how they're going to use that as part of the calculation. I mean, it definitely could, because if you think about it, it's a legitimate number. But how about those families where dad is just totally disenfranchised and is so far behind in child support? I don't mean to be picking on dad, okay, but traditionally, he's disappeared and he's behind in child support. How are they going to handle that? Obviously, that's not a common. If there's a 50-50, there's some give and take that are going on in that. But again, it's yet to be determined.
Well, and that illustrates, and I've had a guest on my show before that is from the government, the federal office of whatever it is, and all the laws are passed, and then it's up to those offices to write all the rules and do all that then implement the letter of the law. So I imagine that's what's going on right now. And
I would bet you're right, not to mention all the reprogramming that's got to go on those archaic systems that the government has. It's not like they're using the most state-of-the-art stuff. There's no doubt there's a lot of work that goes behind the scenes.
Right. So right now, everything is so fluid. So, Andrea, you're asking a good question about an infographic, one place where you can see all this. It's so fluid that's why we have no numbers. There's nothing. So this is where being connected to professional organizations, WACAC, NACAC, NASFA is a financial aid. There's a financial aid. You can go to a free financial aid conference the end of November, beginning of December. Dan mentioned NCAG, National College Advocacy Group. Many people, I belong to that. I'm on the board for that. And it's where we keep track of these college affordabilities and changes and things. So having that affiliation and working with and staying on top of this is something that's going to be important for us. So Dan, we've got a case study. So let's share a little bit of case studies, and I know that'll generate that'll generate some conversation as well. And because we find there can be a huge difference between what a family gets on the Fafsa and what shows up on the profile. And so knowing and understanding why those might be really also demonstrates the differences between the two forms. So yes, like Allison said, she gives a list of FAFSA only schools to families. I do the same thing for that exact reason. So
let me share my screen here, Cyndy.
Okay.
Can everybody see this okay, I hope?
No, it just says, no, yes.
No?
Yes, now I can.
Okay, now it's come up. All right. So this was a case that Cyndy, that you and I put together. Do you want to kind of talk them through it a little bit, or do you want me to do that?
Well, I can, so I can talk them through a little bit. This is, for many of you know, I have Andy Awesome. I've had Andy Awesome as my student for many, many years. So this is his family. So parents are Mr. and Mrs. Awesome. And he is a typical student. His parents are married. There's 4 kids in the family. He's got a younger sibling that's in high school. So they're going to fall into that same thing. They're going to have 2 kids in college at once. And so that is going to be a big part. They are a business. They own a small business. So Yeah, so we do want to mark them as, self-employed. So they're not making a whole lot of money when their adjusted gross income and everything comes out. It's around that 70,000, 100 or 15. So total their adjusted gross income is 85,000. So, a little bit of money that they're putting away for retirement, that's the 12K. So, pretty standard, normal. Where it changes is when you start looking at the assets. So this is where families get really, stretched, is because they have an adjusted gross income low. And talking about depreciation, Dan, I've had families who the colleges have gone in and line item out every single depreciation item on their tax returns and changed a zero EFC to thousands of dollars just on depreciation.
I've run in the same thing, Cyndy. I had a family I worked with a couple of years ago in Florida where their adjusted gross income was a negative $350,000.
Yep.
Which worked if they were applying to a FAFSA only school and if the school didn't get into the nitty gritty, but he was also applying to MIT, which is an institutional school. And in an institutional, just like you said, they had all that depreciation right back into the income.
So what did it do to his EFC?
Oh, it blew it up. I mean, his EFC was more than the cost to go to MIT.
Yeah. So one school you can get a full Pell Grant, and another school you can't get anything. Exactly. And that's what we're demonstrating here. So a little bit of investment, a little bit of cash. This is personal, not their business. That's different. And again, this is California family. Their house is worth $500,000. They owe around, like $520,000. So they've got $320,000 in home equity. And $500,000, $500,000 is the worth of the business and farm. But on the FAFSA, they don't have to show this because it's a small business. But on the profile.
Yeah. Currently, you're right. They don't have to show it, but that's the problem as far as what's coming here in the future is that would have to show up. So,
so you take it from here, Dan.
Well, so, again, this is a good student. It's 3.5, 3.75 weighted GPA. This student makes a little bit of money, as far as what's coming in there. And then the student, but as we know, one of the things that happens is with student assets. This student has $25,000 sitting in their cash savings and checking account. And Cyndy, as you had explained to me, this is not uncommon for these young people in a farm area to have what they'll sell cattle, they'll sell whatever, won't they?
Yeah, they'll raise animals through FFA, sell them at the fairs and stuff. And then, all kids have $30,000, $40,000, $50,000 sitting in the bank.
Yeah. So what the problem is with that number, though, is that $25,000 counts at 20% against financial aid. Yep. And so where we start to see that is, let's kind of dive into the numbers, right? Because if we look at this from a federal standpoint, here's what we're looking at. That $25,000 equals $5,000 that they're expecting the student to contribute from their assets alone, just by themselves. And so maybe there are some strategies that the family should look at as far as what to do with that money because of where it's currently sitting. From the parent side, we've got a parent contribution. I'm going to tell you, this combines two things. It's combining both their income and their assets together into one lump sum, but it's $25,256, which is why, what the program does is it shows the $30,256 up top here. That's the total amount that's being expected to be paid. And for illustrative purposes, that's why we just show it at 30 up top here. But look at what happens from the institutional.
Yeah.
This will rock your world, right? Because of the inclusion of the business, of the inclusion of the home equity. I mean, it's just incredible. And look at how much higher the student is expected to pay. There's a reason for that, because the student actually is supposed to pay it's anywhere from $1,800 to say $2,500 is kind of a range to help you with that the student is going to, be participating. And so what they've done here is they've added the totals plus the money that's sitting in that investment account or that cash and savings, which, by the way, from the institutional or the consensus side counts at 5%. From the federal, it's 5.64%. But look at this number up top here. This is the one that will get you. That's the parent contribution. And so suddenly our EFC is way up there.
It's almost, it's well over double.
It sure is.
Federal.
Yeah. So that's why, you made a really interesting point when we were talking the other day, Cyndy, which is why a lot of times when you're dealing with families like this, you're really focused on, it sounds like, FAFSA only schools. Is that correct?
Mm-hmm.
Yeah.
Yeah, because the other thing that I don't think the government takes into consideration, or the colleges take into consideration, they're always looking at your W-2. Like I was reading on the FAFSA website yesterday, working with a particular family, and it says, well, here's your W-2. Well, not everybody. If you're self-employed and you have your own corporation, yeah, you can be paid with a W-2, but you might be doing a draw. And so there is no W-2. And so, you're basically drawing from your own profits. And that's what the families, and that's very common in especially in ag, but even in business situations. So it's not a one size fits all. And I think that's one of the most important things to understand as counselors and advisors on the financial aid forms and college affordability in particular, in general, is that it's not a one size fits all, and different situations, different families are going to come into this and have to look at this. One of the biggest reasons I work with the families and focus on the FAFSA only many times is because we're not dealing with just one company. These farm families have 3 or 4. They're in business with their aunts and uncles and brothers, and all these people. They may have 5 or 6 businesses over several generations, and to try and figure all that out and put it on a profile, it is very complicated. So but the students want to apply to these schools that have the profile, and the profile is required. Do you think more colleges are going to jump on the profile bandwagon with these changes in the FAFSA? Are we going to see a larger number of schools adding the profile?
Yeah, Cyndy, it's a really good question because, without a doubt, the thing we don't know is the profile going to follow suit with what, is going on here with the FAFSA? Although it's already kind of doing that, the CSS already provides that. I just don't know. We know that there are big public institutions out there that use it, like University of Michigan, UNC Chapel Hill absolutely use the CSS profile in addition to the FAFSA when they're making their determinations. But I just don't know. I think it's going to take some time for the smoke to clear with how these schools and how families and everybody react to what's coming. The problem is it could be, a little too late if we don't get on it because of the changes that are going to impact. Because again, if you think about it, this 69 in a way represents what that family's going to have if 2 kids are in college at the same time versus the 30. That's what we're talking about. That's a kind of an impact that we've got going on. So,
yeah.
One other thing that I ought to point out, by the way, don't forget, so that what we're looking at here, folks, is the College Aid Pro software. In it, this particular package is the advisor software that I use within my practice, but there's also the MyCap software, which is absolutely free for families to be able to use, so they can put in up to 3 colleges, and it gives them a chance to run the numbers. But the reason I bring that up is because what you're looking at here is that this also shows the consensus methodology. And for those of you that may or may not know, that's used by what are referred to as the 568 President's Club. They're also, unfortunately, in the news, or have been in the news over the past few months because of the fears of some collusion with financial aid. But the reason that is important, at least to understand that, is the colleges that are consensus often do not take home equity into consideration. That's why that number is lower. So while this is a CSS profile school, or a calculation, I should say, that's again why it's lower. So the federal's 30, that consensus is 41. And so it's possible when you're looking at schools, you suddenly see that a family may indeed qualify for some need-based financial aid at those more prestigious schools because they've got significant endowment funds that they can help out with. Okay.
Yeah, and that's a much more reasonable thing. Hold on just a second, Carmen. So that's a much more reasonable perspective, like for a family to go from 30,000 to 41, they may be able to manage that. Going from 30,000 to 69,000, that's a whole different story. So, and I hadn't even known about the consensus. So that's very helpful. Go ahead, Carmen.
Can you repeat the name of the free software again?
Oh, sure. It's called MyCap. The easiest way to look at it, and you can even take it for a test ride. Although, let me warn you, if you as an IEC are going to take it for a test ride, use a different email than your regular business email. It's important that you do that in case you ever decide that you're going to, start doing some additional things with it. But anyway, it's MyCap, MYCAP collegeaidpro.com. And if you go on that website, then you can actually get in there. You'll see it's a real easy way to sign up for it. But it helps your families. It will help your families to get an initial idea of what the colleges that their students are looking at. What are the expected family contributions going to be? What might it cost for those 3 colleges that you're considering sending them to? So.
And thank you. And this also, there are other aspects to this. So once you get the EFC, then you can look at, well, what does that look like at other colleges? You can create a what if scenarios.
Mm-hmm.
And there's just a lot of different things that come into this as well. So, and we'll include in the show notes afterwards too. Dan has done a user story on this technology, College Age Pro. I think I need to add it to my website, but we just did a user story on this, and this is also another tool that I'm going to become an affiliate for. So to full disclosure, so you guys know that this is a tool I'm very excited about. I think it offers a lot of great resources. The approach is something that I really is in line with my values and the way I look at things. So I'll be definitely offering more information and resources for this, and we'll also put in the show notes where you can sign up and have Dan do a demo of this for you, right?
That's right. Yeah. And that's really one of the easiest things to do is that if you set that up, it's a 30-minute meeting where I can walk you through it and, just explain to you also the different levels that other IECs across the country are using this type of platform to help their families have the affordability conversation. Because again, the easiest way is for them to plug in their numbers and then for you to be able to see it, as you're trying to help your families with this important topic.
Definitely. So it looks like we've got a question. Allison has a really good question in terms of, are there some pointers you can give us for families of what they need to do in their early years to make college more affordable later? What should we be? We, as college advisors, we're not financial planners. We always give that caveat and that disclaimer, but there are still things that we can guide and recommend for families. So, and go ahead and take it off the screen share for right now.
Perfect. Yeah, that's great. Yeah. So what I was going to say is, let's not forget that whenever we're talking to families about college funding, there are 2 components that come into it. Actually, there's 4, but the 2 biggies are income and assets. Okay. And so whenever you're trying to talk to families as far as some strategies and things that they may want to consider, the timelines can be different because the financial aid forms are always using the prior. So they're looking back 2 years from 2 years back from the graduation year when it comes to the tax return. So for example, our students right now that are graduating here in 2023 are using their 2021 tax return. So if a family is trying to do some things from a business standpoint to try to reduce what their business income looks like, it has to be done early. I mean, you have to start when the students are freshmen and sophomores, which is again why the conversation needs to take place so much sooner if that's going to come into play. Now, assets are a little different in the sense that assets are based on the value of those assets on the day that you submit the financial aid forms. And so what that means is that there could be some things that you can do. it could be that you're going to have a significant expense. So some of the money that's sitting in a savings account could suddenly be used to buy a computer or buy a car, things like that. Depending upon your financial situation, maybe you've got some other significant debt that could be eliminated. And so you pay that off. Because, by the way, don't forget, neither one of the formulas, whether it's the federal or the CSS profile, takes into consideration any of the debt that you have, other than maybe if you've got medical expenses, and that's a professional judgment kind of conversation that you have with the colleges. So, for example, there could be some things that you can do to legitimately help a family reduce their expected family contribution. Notice I said legitimately. I want to be very clear about that. We're not talking about any, wild and crazy things that some people try to promote out there that they should do, but there's legitimate things that can be done. So,
yeah, absolutely. And also, just as you saw in this case study, sometimes, you could move assets around or something, but if it drops it, if you're looking at a $69,000 EFC, what are you going to do to drop it $30,000? Sometimes manipulating and moving things legitimately in different ways, making an investment that maybe you've postponed or whatever is not going to make enough to really move the needle. So, it's a lot of times I'll tell my families, you could do this, or, this is what somebody recommended, but it's not going to make that big a difference. So,
Cyndy, you are so right, because let's not forget the number one contributor to families' expected family contributions is their income.
Yeah.
And so because the income, again, is looking from 2 years prior, granted, you may have had current situations that you need to communicate to the colleges about what's going on. I mean, COVID was a prime example of that, where families were impacted, but that's what they're using to judge your ability to pay. And so, again, if the family's income is consistent from year to year, then moving assets around just to try to reduce that kind of situation is kind of like, moving the chairs on the top of the Titanic around, just not a good idea.
Whereas my families can go buy hay in January versus hay in December,
yes.
And that can make a big difference.
Right.
But absolutely, when you're a W-2 earner and your income and salary is pretty, static from year to year, then there's just really not a whole lot that you can do. And that brings you back to the point that you mentioned earlier, is the earlier you start looking at it, it's like, how much are you putting into retirement? Things like that can make a difference. So that can be a big part. But one of the things that, excuse me, from COVID, though, that really popped up because you had so many families impacted, income reduction, job loss, is the importance of filing a Fafsa, even if you don't think even if you're not going to qualify for need-based aid, should you still file a Fafsa?
Absolutely. I can tell you, in my 16 years of practicing, I've had families lose jobs, become disabled, and even lose parents. And when that happens, that is catastrophic to their planned college funding, or their college funding plan. And so I encourage all my families, regardless of income or assets, to file at least a Fafsa, so that there's a backup plan. Okay, you got to have a backup plan in case something goes a little awry on it. CSS profile, it depends. Let's not forget that the CSS profile is predominantly used for the institution's assets, the money that they're going to be providing to the family. And so that's why they ask for it. That's why they get into the nitty gritty. That's why crazy schools like Harvard, I think they still do this, ask you for the make, model, and value that you assess to the vehicles that you drive. Okay, they're really trying to size you up. They're trying to size you up based on all those types of things, which that's part of the reason why, you have to be careful about giving too much information when it comes to the whole process. Make sure that you answer the required questions. Don't give them anything more than they need.
Yeah. And isn't that the same you do on a legal deposition or anything else? Answer the questions truthfully and honestly, but don't give them more than they ask for, right?
Always. That's exactly right. Yeah. Because if you do, it's going to cost you.
Mm-hmm, mm-hmm.
It will.
Yeah. That's
Dan,
go Go ahead.
Sorry, full scholarships. How realistic is that for high schoolers?
So ask the question
Scholarships.
again, Carmen.
Yeah, full scholarships. How realistic is that for high schoolers?
Okay, you said full scholarships. You're talking full ride. I assume
Yes.
that's what they're asking. Okay. Well, it depends on the school. I mean, let's not forget that the Ivies don't give out any merit scholarships. The Ivy wannabes, it depends on how much, or how easy it is for them to recruit students into their schools. But there's a whole lot of private institutions out there, and even publics and private, or excuse me, publics, whether it's the big flagships or some of the regionals, that have opportunities. Now, look, here's the thing: at a big university, let me use the University of Kentucky. Okay, they'll give 25 full ride scholarships out. That's it. And so you have to know that when it really comes to that, there are indeed a lot of colleges that full ride is going to be much, much more difficult. In fact, I think the number is 1% or something like that. In fact, Vanderbilt University even promotes the fact that even getting scholarships at Vanderbilt, only about 1% of their students get it. So, but there's all kinds of partials. I mean, there's opportunities out there. And then you get into the craziness of in this test optional world. Do you need a test score or do you not need a test score? There are some colleges that you can, just by GPA alone, you can get those scholarships. But in other cases, to get to that upper echelon of those full rides, you suddenly have to provide a test score, to do it. And or there's some states like Florida where you have to provide test scores. So that's a whole nother realm. Cyndy, you've had people on talking about that and having, great conversation about that in the past. So
yeah, that is true. I want to go back to one more thing that bears mention in terms of the issue of whether you file a FAFSA or not. For some colleges, if you don't file your freshman year, you may not even be eligible for financial aid future times. Is that correct?
Absolutely right.
That's not applicable here in California, like in the public schools. But I do know that that's a factor in some colleges.
It is indeed, yeah. And I think you're going to find it predominantly with private schools than you would necessarily with the publics, because I think the publics have to follow the federal mandate, as far as how all that comes down. Mm-hmm. But let's not forget, some families get caught up in thinking that, these federal direct student loans, that it's kind of this pile of money that's there that can just be spent at any time over the 20 or the 4 years that the student is in college. But that's not the case. It's a use it or lose it every single year. So you either use up the $5,500 the freshman year, the $6,500 and so forth, or you don't get to use it. And so that's why families have to really think, about their funding plans. And while they can't project into the future, who could have ever predicted we were going to have COVID, right? Back to what you were saying, Cyndy. I mean, it's just the reality of you've got to always have a backup plan. You have to.
Well, and that goes into what Allison, what you're asking about, and it's a way for us to frame the whole conversation with any of our families. Everybody can qualify. It doesn't matter what your income is. Everybody can qualify for a student loan. So in the federal government and in the whole college financial aid realm on the college side, student loans are a financial aid. So we don't look at it from that way, but so you can have $1 million income, still file a FAFSA, and then that gives you access to the student loans. Student loans are available no matter what. So that's where, whether they qualify for need-based aid, I mean, it's on the federal government, it's Pell Grant or student loans. Now, a lot of states use the FAFSA to help qualify for their state grants. That's the way the California grant is. So you used to have your own financial aid form you had to submit, because they had to do the federal, and then they had to do the state, and then that qualified them. Well, now the federal there is no more state. They use the federal, which is nice. It's nice for families. And I know there are many, many other states that do that. But from a federal perspective, it's basically, those two aspects of it. So, all right. So then Allison brings up the next question.
Uh-oh, is this a doozy?
I don't know if we're going to be able to address this or not. So when the question on the Common App says, are you applying for financial aid? Yes or no? If they're filling it out to get a student loan, what do you put?
This is the doozy. Do you know, I've had this question asked to me multiple times over the last 2 or 3 weeks. First of all, let's unravel why the question's even brought up. The reason the question's brought up is because of the fear that if I make the school aware that I'm considering financial aid, that it might impact my ability or my students' ability to get admitted to the school, right?
Right.
And there's all kinds of folks out there that go one way or the other when it comes to it. I personally think that if a school is going to judge your child based on that there's a problem anyway.
Yep.
That's my own opinion. And if you're truly going to need financial aid, or if your families are going to need financial aid, specifically loans to help pay for college because of the astronomical cost that's out there, that they should disclose it. If on the other hand, this sometimes comes up. If you have a higher income family that is deciding to use maybe the federal loans as a way to put their child's skin in the game,
yep,
then maybe you don't
right.
do it initially, and in the spring you come back in, because you can always do it before the deadlines. You can always apply for those loans and process those types of things. So I just think that that's maybe the right answer. That's the way I approach it.
Why would you want to get admitted to a school you can't afford?
Absolutely.
Well, that doesn't make any sense to me at all.
Yeah, and Cyndy, it's even taken another level. Why would you want to apply to a school or to a college early decision, knowing that the only way you're going to be able to go there is if they give you significant financial aid?
Right.
I mean, are you hoping that something's going to happen? You need to disclose that from the beginning, and also have a realistic idea from the beginning. That's my opinion on it anyway.
Yeah. Yeah. And the colleges want you to do that. I mean, it's not the only thing that's on the form. They're going to be able to see because there are other places where you put your, estimate of your family's income and things like that. They're going to see those other things too. So whether you check that box or not is not going to be the critical thing.
Yeah.
So,
you're so right on. It's so much more than just that box.
Yeah. Yeah.
It's going to come into play with that.
Absolutely. So Allison did ask about, and I don't know the answer to this, and our hour is almost gone.
Right.
If filing the FAFSA is kind of that fail-safe, backup thing, but then do they also have to do the profile? I've always just done the FAFSA. I haven't always done the profile for all the reasons I just said, putting my families through all that hassle of doing it. If I know it's not going to give them, if they've got a $69,000 EFC,
there's truly only one reason I would ever say, especially again, if you're a higher income family, that you should, or that you may have to do the CSS profile. And that's if the college expects it for merit consideration. And there's just a small group of colleges out there that do that. So let me give you an example. Georgia Tech, while they don't require the CSS profile, they do have their own Georgia Tech institutional form that you have to complete. And so in a way, it's like the CSS profile, where you're going to have to give them additional information, and they then do use that when it comes to their merit scholarships. Okay. And so honestly, it's a per school basis that you have to know whether it's required or not. The good news is the vast majority of schools, you can make a judgment call and just go with the FAFSA. So,
yeah. Well, Dan, thank you so much. And thank you, everybody. It's been a very lively conversation. I want to do a shout out to Dorinda. Thank you for sharing your article, and thank you for being here today. And I'm looking forward to learning more about what you do and how you support families in this area. We are going to have more on financial aid. I had announced we were going to have parties Madavi from the University of Montana in 2 weeks. However, that has been postponed. Something's come up. The University of Montana contacted me and said, we can't do it that day. So I'm very excited. We're going to continue this theme of college affordability. Mark Salisbury is going to come from Tuition Fit, and he's going to talk about how demonstrating interest may hurt your pocketbook. I thought it was very intriguing. And we always say, answer all the emails, show them the love. Well, Mark's going to talk about where that might not be the best of ideas all the time. And then those of you who know Peter Van Buskirk, and love him. He's going to come the first weekend in November, and we're going to talk about financial aid from the kind of behind the scenes, from the strategic enrollment management perspective. So I'll be posting all those on my website. So please be sure to join me if you can. Carmen, thank you so much. So glad to have you here. Dan, this has been illuminating, and I love being able to talk to you about this, and I love you being able to talk to my audience about it too. So.
Cyndy, thank you so much for being here, and just best of luck, everybody, as you're out there coaching your families through this. Don't be afraid to help them, when it comes to affordability, because it's a conversation we all need to have with our families.
Yeah. I agree. We have to, this is not something we can ignore or say, doesn't apply to us or the families we work with. And many of you know, when I first started this is what I was told, because I started doing financial aid consulting. And I was told our families, we don't work with families that need financial aid. I knew that was not true. I think that's one of the biggest fallacies that we have in the independent educational consulting industry. And those of you who work with schools and nonprofit groups, it's becoming more and more important. And we didn't even talk about our undocumented students and how do they get financial aid. And so that's another big issue and passion of mine, is helping our undocumented students to be able to find the funds for financial, to go to college and for higher education. So we'll be back in 2 weeks. Everybody enjoy your weekend. And again, thank you. Carmen, thank you. Thank you, everyone. Keep up the good work. Take care of yourself. Self-care right now is we're all just drowning in everything. So make sure you do that self-care too. Okay.